All right, welcome back to Talk Tickers. Today we are digging into Five Below's absolute monster of a third quarter earnings report. I mean, the stock was already running hot into the announcement, and boy, did management deliver. Let's get right into it.
Okay, let's just start with the headline number, the one that made everybody's jaw drop. We're talking about a roughly 200% surprise on adjusted earnings per share versus what the street was expecting. I mean, this wasn't just a beat, folks. This was a statement, a huge signal that whatever they're doing, it is absolutely working.
All right, first up, the Q3 blowout. Let's take a look at the numbers and see what really got the market so excited.
So take a look at this table. The outperformance here is just across the board. It's not like they just squeaked by on one metric. No. Adjusted EPS, 68 cents. The consensus was, 22 to 23 cents? They didn't just beat it, they crushed it. Revenue topped $1 billion, beating by about 60 million. And then there's the big one, that comparable sales growth of 14.3%. That is a massive, massive acceleration.
And just to put that comp number into perspective, check out this chart. So you've got Five Below posting over 14% growth, and then you have the broader retail sector, right? The XRT ETF. It's been pretty much flat for the last year. This tells you everything you need to know. They aren't just riding some retail wave here. They are paddling their own canoe, and they are leaving everyone else in their wake. They are absolutely dominating their peers.
Okay, so the big question is how? How did they pull this off? Let's get inside their growth engine and see how they did it. Turns out it's a really clear playbook, and it's definitely paying off.
So, on the earnings call, the CEO, Winnie Park, she laid out 3 core pillars. Pretty simple, really. First, they've got this laser focus on their core customers, Gen Z and now even Gen Alpha. Second, they're creating this seamless journey, from seeing something on social media to actually walking into the store and finding it. And third, they're expanding what they call their value architecture, which is really just a fancy way of saying they're getting a lot smarter about how they price things that cost more than $5.
And this quote from her really gets to the heart of it. Remember that Five Beyond section they used to have where all the more expensive stuff was cordoned off? Well, they got rid of it. Gone. Instead, they just started putting those $7, $10, $15 items right where they belong, in the normal aisles. And guess what? Customers loved it. It was an instant hit. Plus, it freed up all this prime real estate in the store for big seasonal displays. It sounds so simple, right? But what a genius tactical move.
And get this, management made it super clear that the growth was really healthy and balanced. That big 14.3% number wasn't just because they were jacking up prices. Nope, it was split almost perfectly between an increase in transactions, so more people walking through the doors, and a higher average ticket. That is literally the holy grail for any retailer. You've got more customers coming in and they're spending more money. You just can't ask for better than that.
Okay, but a great quarter is one thing. Wall Street always wants to know, what have you done for me lately? So let's look at the road ahead. What did management guide for, and what were analysts asking about?
And here it is, the classic beat and a raise. I mean, for the second quarter in a row, they raised their full-year outlook. They boosted the net sales forecast, they bumped up their comp sales expectation to around 10%, and they lifted the EPS target. You don't do that unless you are feeling really, really confident heading into the make-or-break holiday season.
So during the Q&A session, you could tell analysts were all thinking the same things. They were really pushing on a few key topics. First, can you guys keep this up? Are these mid-teens comps for real? Second, how's the holiday season starting out? And third, what's the deal with inventory? Because it's up a lot, mainly because they were trying to get ahead of any potential tariff problems.
And about that all-important holiday question, management basically said, yep, we're on track. They confirmed a good start to the fourth quarter, said that Black Friday weekend went pretty much exactly as they expected. That's huge because it backs up that new, higher guidance they just issued. It really looks like that Q3 momentum is rolling right into Q4.
Okay, so let's put it all together. Time for our analysis. Here's the official Talkaticker's take on Five Below. This is the next call.
So for the next call, our outlook is that they'll probably meet or even slightly beat their already raised Q4 guidance. The way we see the stock moving, look, the market is going to keep rewarding this kind of best-in-class execution, especially when consumers are watching every penny. This stock has serious momentum, and this quarter just poured gasoline on the fire for the bulls.
Right now, the average analyst price target is somewhere in the mid-170s. But we think the flawless execution we just saw, combined with this strong performance, is going to justify a move higher. We see it pushing towards the upper end of that range, up toward $180 a share, as the market really starts to digest this reacceleration story.
So,
That brings us to our rating. It's a simple one: outperform. I mean, come on. You have a consistent beat and raise story, a strategy that's clearly working and picking up speed, and they're taking massive market share in what's a really tough environment for other retailers. This is an absolute standout.
And that brings us to my favorite part, our final segment, the outrageous but plausible trade idea, something to think about based on this earnings print.
Okay, so here's the trade. Given how strong this report was, a big drop in the stock feels pretty unlikely, right? So the idea is to sell an out-of-the-money put spread. What's that? Well, it's basically a way to collect some income by betting that the stock will stay above a certain price. You're getting paid to say, I think the floor on this stock just got a whole lot higher.
And you know the drill. Our final reminder, this is not financial advice.